Welcome to this video post from Fields Capital Strategies. In this presentation today, we will discuss a strategy to pay off your debt by using the private banking concept. Let's begin by considering the first principle one should understand in regard to your finances, and that is, you finance everything that you purchase or spend your money for. You either pay interest to someone else by borrowing money through loans, credit cards, charge accounts, or you give up the interest you could have earned on your money by paying cash for those purchases. In this strategy, we will look at a system that will allow you to reduce your debt while at the same time you increase your savings. This strategy allows you to grow your money through compounding and use your money through collateralization. So, let's begin by looking at strategies to reduce our debt. That financial burden that weighs us down. That burden we seem to never to be able to get out from under. Debt. Today's leading gurus preach getting out of debt, which is sound advice to a point. You absolutely should get out of debt to conventional lenders, banks, credit cards, finance companies and such. But you should always be in debt to yourself. Never pay cash for your purchases. Finance those purchases yourself and then pay yourself back. Loan yourself the money and then pay it back with interest. Let me illustrate this concept through the process of reducing our debt. Today's gurus teach their followers to throw every dollar they can find onto their debt by working extra jobs or reducing their spending to generate additional dollars to put toward debt reduction. So, for example, let's say you are paying $100 each month on credit cards, $250 on your car payment, and $750 on your house payment. And let's say you find or generate $500 extra each month to put toward paying off these debts. The current strategy would be to put the extra $500 on your smallest debt, or the debt with the highest interest rate, like credit cards. Then, once you have paid off that debt, your credit cards, apply the $500 plus the $100 you were paying each month onto the next debt, your car payment. So now you have $600 going toward your car payment. And when the car is paid off, apply that monthly payment to the $600, and now you're paying an additional $850 each month on your last debt, your mortgage. So now you are paying your $750 monthly mortgage payment plus $850 towards principal from your other payments on your mortgage. That's $1,600 each month paying down your mortgage. And you can see how this strategy can work. You will be out of debt sooner than you could have ever hoped for. But where are you when you get out of debt and you need a new car? What are you going to do? Borrow money and get back into debt because you have not accumulated cash reserves. You have put all of your extra cash flow toward paying off debt. You have equity in your house, but how do you access it? A home equity loan? Where are you then? You're back in debt. And what if you lose your job or get sick and can't work for a while? Will your banker understand that you have made all these extra payments on your mortgage and now you need to wait until you are working again before you resume making your house payments? Or will he let you have that extra money back you have been paying on your house all this time to live on while you are out of work? Would your banker loan you money against your home if you were not working? Probably not. You see, by putting all this extra money on your debt each month, your debt is decreasing faster, but if you were to need that money, you don't have access or control over it anymore. The bank does. And who benefits from this strategy? The bank. They have a smaller loan outstanding with a lot of equity you have created for them in their collateral, your house. And you have equity in your home, but you can't access that money without going back to the bank and going into debt. So, as an alternative strategy, what if we took that extra $500 a month and created a pool of money to reduce our debt, create our own bank, a warehouse for our money? We could start accumulating cash strictly for debt reduction. And when we accumulate enough money to pay off debt number one, our credit cards, we use this cash we have accumulated as collateral and borrow against it to pay off debt number one, and leave our money growing in the bank uninterrupted. When we pay it off, our credit cards, we can then start funding $600 a month into our bank until we have enough money to collateralize and pay off number two, our car payment. Then we are setting aside $850 each month until enough has accumulated to pay off the mortgage. Now, the strategic advantage to creating this debt reduction bank or pool of money is that we have access to this money if the need arises. This money is in our control, not the bank or the finance company. We still pay off our debt as soon as possible, but we have flexibility with the money, access to the money, control of the money, and if our income or cash flow is interrupted, we have available cash to keep our debts current until we are back on our feet financially. Now, this strategy, or any strategy to reduce our debt, will require a change in our thinking, our attitude, our conviction. We must be committed to following the plan we have set for ourselves to get out of debt. And once we are debt-free, we continue the process of accumulating money in our bank so that when we need to make a purchase that we would normally go to the bank and borrow the money for, we loan it to ourselves and then pay ourselves back with interest, all the while using our money and growing our money. We use this money as collateral to loan ourselves the money we need. Now, the key to this strategy is properly structuring your private bank. This vehicle to hold and accumulate your money, it must be, number one, safe and secure, with no risk of loss. Therefore, it's not in the stock market. Number two, it must provide guaranteed growth at a respectable rate of return. Thirdly, it must have positive tax results, tax-free or deferred growth and use of our money. Fourthly, it must provide you with complete access to your money when you need it. And fifthly, It must allow you total flexibility on how you use your money. Private banking is a strategy to allow you to grow your money through uninterrupted compounding, while at the same time allowing you to use your money however you see fit. And then when the time comes, you can withdraw this money tax-free for retirement and pass it on to your children tax-free. That's guaranteed, uninterrupted growth for your money, guaranteed security for your money, guaranteed access and flexibility with your money, providing strategic tax advantages for the growth, the access, and distribution of your money. So, if you are interested in getting out of debt and building your wealth at the same time, contact us at Fields Capital Strategies and let us show you how to properly structure your private bank. There is no cost, no obligation. Let's simply discuss your financial needs and goals and where you want to be. Thank you for watching this video post. Please subscribe, comment, share this video, or follow the link below for more information. We hope to see you next time here on Fields Capital Strategies.